So I want to ask a little bit about some of the new investing things going on in the markets. And Greg Wondra from Bakersfield wonders about target date funds. And I wanted to also ask about all the new index funds with a brain. Are those things really adding value?
No, probably not. The S&P 500 index fund is the one to use. That's the one I used in that bet I made for 10 years. It's the one I've told the trustee for my wife to put 90% of the funds I leave her into. The S&P 500 is, I don't know whether it's 80% of the market value of everything you can buy in this country, and it's over. I think it's over 20 trillion. And you're buying America. And let me give you a figure that'll blow your mind. I think I bought my first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75, three shares, $114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today.
Oh man!
Well, it's
okay.
But I just want your audience to think for a second.
Okay.
The answer is about $400,000. Oh. So if I, as a little kid, had taken that $114 I'd saved shoveling snow or whatever I'd done, $400,000 today, one person's lifetime. That's America. I mean, that isn't me. It is the huge tailwind the American economy gives to any equity investor. Now, the market's gone down many times during that time. People have panicked during that time. Headlines have been terrible. It looked like we were losing the war when we first bought it. But America is a powerful economic machine that since 1776 has worked, and it's going to keep working. Now, you don't want to buy to hold for a year. You don't want to buy with the idea that you could sell it in 2 years or 3 years, necessarily make money. You could lose money that way. But if you buy it for 10, 20, just keep buying the S&P 500 index and forget about all the other nonsense that's being sold to you, because I'll guarantee you one thing about the stuff being sold to you: it will carry bigger fees than what I'm talking about.
Yes.
Yeah.
And there's no reason to think that we don't know if it's 400,000, but that same sort of process or returns won't happen starting right now.
The S&P 500 companies have earned well over 10% on equity, often 15% annually for years and years and years and years. They've done it with Democratic administrations, with Republican administrations. Now, you get money compounding at that kind of rate underlying your investment, and you get a diversified group of that. I mean, you're going to do well.
Okay, so let's fast forward to July 2021. Okay, now, just true to what Warren Buffett said, the best index funds or exchange traded funds are those ones that typically mirror a larger index or some large companies, at least so far. Now, check this list out: best index funds for July 2021. I'll go over them very quickly to show you what to look out for before you invest in index funds. And by the way, do remember to leave a like and subscribe if you're getting content, and come back for more on this channel. So the first one on this list is the Fidelity Zero Large Cap Index. Okay, one thing you must know is the focus of the index, the provider of the index, and the management fee of the index. So what's the provider right now? Fidelity. Okay, what's the focus of the index? Large cap. That means large capitalization companies. That means big companies. And what's the expense ratio or the fee the manager charges on that index? 0 annually. So for every 10,000 invested, there is no charge for that. Okay, moving on to the second index, which is the Vanguard Sp 500 ETF, ticker VOO. Who's the provider? Vanguard. That's a massive asset manager in the US. What's the focus? The biggest 500 companies in the United States. And what's the expense ratio? How much do the managers charge you? 0.03%, which means for every $10,000 invested, you just bear a cost of $3. That is so low. The third on this list is the Spyder Sp 500 ETF Trust, ticker SPY. Spyder is the provider. It's focused on 500 companies in the US, the biggest 500 companies, and the expense ratio is 0.09%, which means you will pay a $9 fee per annum. Now check this out, guys. If I'm torn between the decision of investing in Vanguard and Spyder, the differentiating factor for me might be the fee, because I could get about the same return for a less cost right here. This is $3 per annum, while this is $9 per annum. So that's why you have to look closely at the different parameters. Okay, the next one is the iShares Core S&P 500 ETF managed by Blackrock. Okay, Blackrock is a massive asset manager in the United States, and that has a 0.03% rate of expense, which is $3 per annum. So already you can see how I analyze index funds. I look at the managers, I look at the focus, and I look at the fees. That tells me the one offered by Blackrock gives me a $3 annual payment, and the one offered by Vanguard gives me a $3 annual payment. So if I'm to invest in any fund that tracks the top 500 companies in the US, I would likely not go with the Spyder because of that fee. The last one on this list is the Schwab S&P 500 Index Fund, okay, managed by Charles Schwab. All right, now check this out. The expense ratio on that one is 0.02%, which means for every $10,000 I invest, I would simply be paying $2 annually. So guys, based on this quick information I've given to you right now, what is the lowest cost right here? It's the Schwab. So if I'm to invest in an S&P 500 index fund, I would most likely go with Schwab because it has the same parameters I would likely get from others at a lower cost. So let us do a quick calculation. Let's take an example that I go with the Schwab S&P 500 index fund and I invest $1,000. Okay, assuming I make a 10% rate, which is typically what the stock market has done historically in the last couple of decades, and I keep that investment for 20 years, adding $100 every year to my investment, my value at the end of the period comes to $13,371. Think about it. With just $1,000 compounded at 10% interest rate for 20 years and additional deposits of $100, I am getting $13,000 at the end of the period. Now the beauty of it is this: if I start out with something bigger, say $10,000, and I have a longer period to my retirement, say I have 40 years because I'm just 20 years of age, and because of the 10% return, all right, I can easily just put in an additional $500 every month. Say I earn well and I can do that to my paycheck. When I check my end value at the period when I'm supposed to retire, you can see I have $788,000. That's what Warren Buffett was talking about index funds. The beauty of index funds is in the compounding effect, which comes to play when you set aside the funds and you keep adding bit by bit into the funds, no matter how small that amount is. So that's what I have for you in this video. As always, please leave a like and subscribe and come back for more of this content. Cheers.